Recent events have brought into sharp relief the importance of having a solid financial foundation. Emergency funds, side hustles, and good budgeting and investing fundamentals are not always the sexiest topics to discuss when things are going great in the markets, but when things take a turn for the worse, we're all glad that we have them in place. With that in mind, today we're going to be starting up a new mini-series on this channel, which I think you'll all enjoy. A while back we did a budgeting series where we went through many of the most popular budgeting forms out there. We looked at their strengths and weaknesses, as well as who they might work best for. I'd like to do something similar with many of the different investing strategies out there. And given recent events, I think there's no better time to kick that series off than right now. So here's what we're going to be doing in each of these videos. We'll be analyzing a specific investment portfolio to see how well it has performed over the years in 4 primary aspects. The first aspect will be a return analysis, but we're not going to just be grading it in terms of its long-term returns. We will look at those, but we'll also be grading the strategies on their historical volatility, how often the strategy has lost money, even if only temporarily, and how sensitive it is to sequence of return risk, which I'll be referring to as start date sensitivity going forward. The second aspect will be a crash analysis. We'll be grading the strategies based on how deep of a drop it experienced during the downturns, but also how quickly it recovered from them. The third aspect will be a financial independence analysis. We'll be grading the strategies on how quickly you could reach financial independence using them under various circumstances and time periods, and how much money you could withdraw from it to live off of when you retire. The fourth and final aspect will be how well the strategy has managed to accomplish its primary goal, because not all investment strategies are trying to achieve the absolute highest long-term returns, so it wouldn't be fair to just judge them on those grounds alone. Some are trying to minimize volatility, even over the short term, so that the investing journey is as smooth as possible. Other strategies may be going for something else entirely, but knowing this will help us decide who the strategy may be well suited for. As you can no doubt tell by the length of this video, there's a lot of information we're going to be sifting through. And given this most recent economic downturn we're going through right now, I think there's no better strategy to kick this series off than the permanent portfolio. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The permanent portfolio was created by Harry Brown in the book Fail-Safe Investing. It has since gained traction and become one of the more well-known portfolio allocations out there. The portfolio consists of 4 different assets, all of which get an equal 25% share of the portfolio's value. The first asset is the stock market. Generally, a simple S&P 500 or total stock market index fund is recommended. The second asset is long-term U.S. Treasury bonds. The third is gold, and the fourth asset is cash, or some sort of cash equivalent. The primary goal of the permanent portfolio, at least as I see it, is to give investors a reasonably stable investing journey, one that's capable of specifically performing well, though maybe not ever exceptionally, in just about any economic situation. This is where its name comes from, as it's supposed to be a portfolio that you can stick with permanently, regardless of age, race, income, or outside circumstance. During times of prosperity, the stock market will generate strong returns for you. In periods of high inflation, the gold is meant to give you some form of protection. In times of deflation, long-term treasuries will give you steady returns. And finally, during recessions, cash is king. But with that being said, how well does it actually achieve this goal? Let's find out. We'll start by analyzing the returns. To analyze the returns, we'll be looking at a few different metrics. We'll be looking at the long-term 40-year inflation-adjusted returns for every single year starting from 1927 through the end of 2019, since that's the last completed year I have available to me at the time of this recording. We'll be paying particular attention to the number of times the portfolio lost money, and how severe those losses were, since limiting the severity of those down years is one of the primary goals of this strategy. We'll also be taking a look at how dependable or trustworthy the strategy is by examining how sensitive the long-term returns are to when you decided to start investing. So at least based on the data I have, since 1927, the average 40-year inflation-adjusted return for the permanent portfolio is about 3.4% per year. Its worst-case return is around 1.4% per year, assuming you began investing in 1936 or 1937. And its best scenario was an average return of around 5.1% per year, assuming you began investing in 1972. That suggests that a $10,000 investment would grow to, on average, around $38,000 over the course of 40 years, after adjusting for inflation. At worst, you're looking at a nest egg of around $17,400 and at best around $73,100. Those are not exactly eye-popping numbers, but again, high long-term returns aren't what this portfolio is primarily focused on. Let's look at some volatility metrics. The average standard deviation of returns is about 8.6%, which means that in any given year, we can expect that most of our returns will fall somewhere in between the negative 5.2% and positive 12% range with this portfolio. There will obviously be a few exceptions, but for the most part, that's what we're looking at. And the return diversity chart bears this pattern out. According to the return diversity chart, the largest portion of our annual returns, 45 out of a total of 93, fell between 0 and 10%. Looking at the individual returns each year, we see that a whopping 82% of those returns fall within our negative 5% to 12% range. The majority of the ones that don't fall within that range are not missing it by very much, at least on the loss side. There were only 7 years where the returns were worse than 5.2%. They were in 1938, 1942, 1947, 1948, 1970, 1975, and 1982. The worst of those returns was a 16.8% dip in 1947. All things considered, that's not bad at all. Those that missed the mark on the positive end did tend to miss it by a wider margin, including a 39% leap in 1980, but hey, who among us is going to complain that our investments did much better than we expected? But getting back to the down years, there were a total of 25 years, again out of a possible total of 93, where the portfolio failed to keep pace with inflation. That's a loss frequency of about 27%, but as we just covered, the vast majority of those losses were to the tune of 5% or less, and the majority of them were recovered from reasonably quickly. We see this bear out in the 10-year rolling returns chart. With the exception of the 6-year stretch between 1947 and 1952, as well as 1954, when the economy was still largely working its way out of the Great Depression, the permanent portfolio has never lost money over a 10-year span, even after adjusting for inflation. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it here, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is. It's a good way to get an idea of how dependable or trustworthy an investment strategy has been historically. The reason we care about this number is because we don't know what the future holds, but we do know that it will affect us financially speaking, as well as emotionally speaking. I mean, think about it. Someone who began investing all their money in the stock market in the early 1990s would have had a much better investing experience than someone who began investing in 1999 or 2000. The 1990s saw double-digit growth throughout most of the decade, while the 2000s is sometimes referred to as a lost decade, because the stock market failed to grow during that specific time period due to the dot-com crash and the Great Recession. These wildly differing experiences would certainly have an effect on our finances on paper, and in particular in the latter example, it could make us more likely to sell out of our investments during some of those longer downturns, either by choice or necessity. Even if we were fortunate enough to not sell our investments during the 2000s, seeing the difference between the returns we actually got and the 10-year returns that were advertised to us on the fund's prospectus back in 1999 or 2000 would be disappointing. So ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance during our time frame, as low as possible. The permanent portfolio, all things considered, appears to do that reasonably well. There are still some notable over- and underperforming stretches. For instance, a 1937 start where the following 10 years, from 1937 to 1947, underperformed the prior 10 years, from 1927 to 37, by an average of a whopping 9.7% per year after adjusting for inflation. Or a 1949 start date, which saw the 10 years from 1949 to 1959 overperform the prior 10 years from 39 to 49 by an average of 6.7% per year. This gives us a total start date sensitivity from 1927 to 2019 of 16.4%. However, as I said, in the grand scheme of things, this sort of spread is not too terribly bad, especially over this long of a time frame. Just to give an example to compare it to, if you had invested 100% of your money into a large cap blended fund, something much like the S&P 500 is, your total start date sensitivity would be 35.4% for this same time period. The largest overperformance would have been with a 1949 start to the tune of 16.1% per year. The largest underperformance would have been a 1999 start where the investments fell short of the prior decade by an astonishing 19.3% per year. So again, the permanent portfolio is not holding up so bad in this metric. But that'll just about wrap it up for our return analysis. Now let's move on to looking at how it handled itself during the worst of times. So a crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, that you'll be able to weather the storms when they come, both financially and otherwise. In these videos, we'll be looking at a few different metrics when analyzing the crashes. First, we'll take a look at how deep the various crashes were for the strategy. And second, we'll look at how quickly the strategy managed to fully recover and set a new all-time high. And third, we'll actually also be looking at the Ulcer Index. The Ulcer Index was developed by Peter Marin and Byron McCann in 1987 for analyzing mutual funds. They later published it in their 1989 book, The Investor's Guide to Fidelity Funds. It measures the downside risk in terms of both depth and duration of price declines. So in other words, it largely combines the first two metrics we're looking at into one number, which will make it a little easier to compare different strategies against one another as we move forward in this series. But anyway, the deepest crash for the permanent portfolio came during the 1940s. The worst of the stock market's woes were behind it, with that portion of the portfolio reaching bottom in the early 1930s, but during the early parts of the Great Depression, we actually experienced some deflation, which helped to somewhat preserve buying power despite the losses in price. From 1927 to 1933, the CPI, which measures inflation, fell from around 17.5 to 12.9, or by about 26%. However, by 1949, it had almost doubled to around 24. And given that the stock market hadn't fully recovered by then, the portfolio did eventually fail to keep pace with that inflation. By 1949, the portfolio's real value was around 26.5% below its all-time high, which was set in 1940. Unsurprisingly, this was also the crash that took the longest to recover from, with the all-time high being set in 1940 and a new all-time high not being set again until 1956. So we're looking at a solid decade and a half of treading water. The Ulcer Index during this time period rose to as high as 2, though for the entire 93-year span it was often much lower, on average hovering around 0.4. But if we exclude the single worst crash and look at the portfolio's performance since, say, 1950, the numbers look quite a bit better, suggesting that while a 26% crash, lasting for about 15 years, is bad, it's a fairly unusual occurrence with this strategy. Excluding the Great Depression, the worst crash we've ever seen with this strategy was largely a result of higher levels of inflation that was experienced during the late 1970s and early 1980s. From 1981 to 1985, the portfolio lost as much as 16.7% of its inflation-adjusted value, and recovered fully in 5 years. This was technically the second worst crash of this portfolio's history based on the data that I have. Interestingly, it had handled itself pretty darn well during the more recent downturns. The dot-com crash, for instance, only forced a 1.7% drop in the portfolio's inflation-adjusted value, and it recovered in 2 years. The Great Recession of 2008 caused another 1.9% decline, but by the start of 2010, it was already setting a new high. Now, I should note that due to the vast amounts of data that I have here, there's around 50 different asset classes that I have in this spreadsheet, with some having data going all the way back to 1871, so I'm only using yearly data. So these drops may have been a little bit more intense if we looked at it on a month-by-month basis, but by year's end, this is what we're seeing. So when I say there was only a 2% drop during the Great Recession, in this case it meant that the portfolio was sitting at its all-time high as of January 1st, 2008. By January 1st, 2009, it was 2% below that all-time high, and by January 1st, 2010, it had recovered to set a new all-time high. So we had a max drop of 2% from that all-time high in 2008, and only 1 year during that time frame when a new all-time high was not set. I hope that makes sense. All in all, I would say that this is not half bad. It seems that the strategy's greatest weak point is sustained levels of high inflation, which can be tough for any strategy to deal with. And when compared to a more aggressive portfolio, such as an all-stock one, it's certainly much more stable. For instance, a 100% large-cap blend portfolio, like the S&P 500, would have experienced multiple decade-long stretches where it basically treaded water. From 1930 to 1936, it failed to break the highs set at the start of 1929. During this time, it was as much as 55% below the all-time high set in 1929. It did break those highs briefly in 1937 before going through another 8 years of turbulence where it again didn't set a new all-time high until 1946. And even that was followed by another 4 years of treading water. From 1974 to 1985, it failed to break the all-time highs set in 1973, falling below those highs in this case by as much as 48% at its worst. And of course, from 2001 to 2013, we failed to break the all-time inflation-adjusted highs set at the start of 2000, at least on a yearly basis. We fell below it by as much as 43%. So while I would love to see a little more stability, particularly when it comes to dealing with inflation, and perhaps we will as this series goes on with other strategies, it certainly is a massive improvement in the area of handling crashes compared to some other strategies. And given that this was arguably the primary goal of this strategy, that is a good sign. But that'll do it for the crash analysis. Let's move on to examining the permanent portfolio in regards to financial independence. So financial independence is not the permanent portfolio's strong suit. It obviously does do reasonably well when it comes to stability during crashes, as we just saw, and that's great. But with the long-term returns being on the lower side of things, its ability to reach financial independence quickly and maintain high levels of safe withdrawal rates during retirement does get hampered a bit. We'll start by examining those drawdowns. Historically speaking, the permanent portfolio would have maintained a minimum safe withdrawal rate of 3.15% over any 30-year stretch. That falls to 2.6% over any 40-year stretch and 2.34% over any 50-year stretch, at least from 1927 through 2019. The worst year to retire using this strategy was, without question, 1937, as that's the year all of these minimums were set. I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 4.91%, 4.22%, and 3.77% for the 30, 40, and 50-year stretches, respectively. And the maximum rates for the same durations were 6.59%, set in 1979, 5.91%, also in 79, and 5.19% in 1970. The permanent portfolio would have maintained a minimum perpetual withdrawal rate of 1.91%. And just so we're clear, I'm defining perpetual withdrawal rate as the highest withdrawal rate that could have been sustained while still maintaining your original inflation-adjusted principal all the way through to the end of the data set. So if you had $1 million in your nest egg when you settled down in 1927, that perpetual withdrawal rate would still leave you with at least $1 million worth of buying power by January 1st, 2020. In raw dollar terms, because inflation makes the dollar less valuable over time, your net worth would really be something north of $20 million. But anyway, I hope that makes sense. Those figures are a bit on the lower side of things, particularly as you get into longer time frames, but where the permanent portfolio really falls short is in the accumulation phase of financial independence. The accumulation phase, as the name suggests, is where you're still putting money away for your financial independence. The primary metrics here is what percentage of our income we're saving, how our expenses change over time, how long we plan to be retired, and how long it'll take us to reach financial independence based on that information. Assuming that our expenses changed at the same rate as inflation, we were planning on a 30-year retirement, and we saved a fairly standard 15% of our income using the permanent portfolio strategy, we would actually never reach financial independence. Yeah. Even if we invested 15% of our income consistently, starting in 1927, we still would not have reached financial independence under a 30-year retirement. And I'm not going to lie, that actually shocked me a bit. It's pretty abysmal. The reason for this outcome, though, is actually pretty obvious when you look at it. We know that the returns were not super high, but they did outpace inflation for the most part over the long run. However, our expenses were growing with inflation, and since our 30-year safe withdrawal rate using this strategy was a mere 3.15%, every dollar of additional expenses we incurred equated to almost $32 of additional savings that we would need to reach financial independence. And we just didn't have a high enough savings rate to catch up with that in this scenario. A similar story can actually be found if we even bumped our savings rate up to 30%. However, when we bump our savings rate up to 50% of our income, we finally break through. Most of the time. Out of the 93 years of data I have available to me, someone investing this way under these assumptions would have reached financial independence eventually 53 times. I mean, that's fine. We don't expect a 100% success rate here because that would actually suggest someone investing 50% of their income in 2019 or January 1st, 2020 would be financially independent by January 1st, 2020, and that's just not likely to be the case. So a 57% success rate is not as horrible as it seems on its face. though I still would personally like to have seen that number pop up a little bit higher with a 50% savings rate, or even just reach this level of success with a lower savings rate. On average, it takes around 57 years to achieve financial independence using this strategy. The fastest someone would have reached it was 28 years, assuming they began investing in 1992, and the longest it would have taken in the instances where it actually did eventually reach financial independence was 82 years, assuming you began investing in 1933. With a 70% savings rate, the numbers were finally getting to a more acceptable level. We had 82 instances where financial independence was eventually achieved. That includes every single starting year from 1927 to 2008, and if you had began investing in 2009 or later using this strategy, you wouldn't have reached financial independence under these assumptions quite yet, but you're well on your way. Again, we don't expect a 100% success rate with any of these accumulation tests, but on average, it took around 18 years to reach financial independence under these circumstances. The quickest path took 7 years, starting in 1927, and the longest was 31 years, starting in either 1963 or 1965. So as you can see, financial independence, and particularly the portion of the journey where you're saving money for your future, is not where the permanent portfolio shines the brightest. It doesn't sustain incredibly high withdrawal rates, especially over longer retirements, and unless you're saving a crazy high percentage of your income, it tends to take quite a while to reach your goals due to the generally lower long-term returns. What it does do reasonably well is smooth out the investing ride. Your start date sensitivity is reasonably low, the severity of your crashes are fairly muted when compared to more aggressive strategies, and to me, that's what this strategy is mostly aiming to do. It's meant to do reasonably well in various conditions so that you can have a more comfortable investing journey. And for some people, that's exactly what they're looking for. For others, the drawbacks are going to be too much to deal with. Personally, I fall into that camp at the moment, and that's perfectly okay. There's many different investing strategies out there. This is just the first one we're covering in this series. But I hope you got something out of it, even if this strategy isn't the one for you. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.